Hi there, it's Martin here, and today's subject is on my podcast, which is broadcast internally, externally. Um, what makes a business worth buying? Well, a very interesting subject. So I think first of all, what I would say is look at the overall sector. And as I keep saying, is it in a rising tide? So I've said like 20, 30 years ago, mobile telephones, or is it a decreasing tide? Like um, let me think of some sectors. Diesel cars, for example, and certain technologies that have been bypassed that are decreasing and that may well not be around in the future. So, what is happening in the sector, and don't just think nationally or locally. Think nationally, I mean just within, for example, Great Britain. Think internationally. What's happening in Europe? Certain things are decreasing in some countries while they're still increasing in other countries. So what is the potential there? Um, and that's a very, very, very important thing to understand because you don't want to get locked into something that in a few years' time nobody's going to want to buy. So what's happening in the sector? Do your research, your macro research. Um, is there still potential in other jurisdictions, other geographical areas? Then look at before we even look at the numbers. Okay, I'll come to that in a moment. And by the way, you'll see here that we've been awarded the top SME, small to medium sized enterprise investment banking services for 2026 by a prestigious magazine, the European version of Financial Services Review. There's also an American version of it and an Asian version of it. They contacted us some months ago. They've done the due diligence. They've spoken to our clients, and we've been awarded this. So we're quite proud of that. And it's going to be published in October of 2026. So you'll see the article then. Um, Look at the management before we even get to the numbers. What do you think of the management? Do you think they've been good custodians of this business? It might sound strange because it could be a business they've been running for, up to 30, 40 years. But are they people who've made the best of it, or persons, or a person who've made the best of it? Have they really developed the business? Have they gone into new markets? Have they gone into new geographical markets? Have they expanded? How have they worked in the business? Um, to give you a good idea of what the potential is, how do you rate the existing owners? Um, and what do you feel? So that will give you an idea of what the future potential may be. Have they been doing marketing? How are they set? Do they have a salesman? Do they just refer on referrals coming in from previous clients? So those are things to look at. And of course, in that has to come the reason for sale. Many of you will know that a major reason out there is retirement. Boomers of my generation are looking to sell businesses. You can understand that. They want to go off and play golf all day. They want to sit by the beach on the Mediterranean and the Caribbean. They'll soon realize that's pretty boring. But hey, if you've been working in a tough business for years and years, you really, 2 weeks holiday is not enough for you. You want more. So, okay, retirement is a sensible case. It can be relocation. It can be illness, unfortunately, dread diseases. It can be, as I said, divorce, wanting to go and live with the kids or the grandkids in Australia, a whole host of reasons. However, we see business being sold fairly quickly after they've been bought. You will see on a balance sheet, if you see intangible assets, that could be some kind of value in the business, which is maybe a software program or whatever. But often intangible goodwill is created when a business is purchased. So, a hot tip, if you see intangible assets on the balance sheet on top of tangible assets, physical assets, then if it's a substantial amount, you will almost certainly know that that business has been purchased before by the current owners. The difference between what they've paid and what the book said comes out as goodwill intangible assets. So you then start to wonder, whoa, how long ago did they buy this business? And why are they selling it now? So reason for sale is crucial. Then, of course, we come to the accounts. And you don't need to be an accountant, but understanding financial statements is really, really important. First of all, we typically look at the profit and loss account, see what's been happening. Are revenues up? Are they consistent? Us accountants do look for consistency. We get concerned when there's suddenly a big hike in revenues, profits, whatever. It may be good, new clients and whatever. That's great. But even worse, if there's a sudden drop, or in the previous year, because when you're looking at the accounts, you see 2 years, you see a big divergence between 1 year and the next, and you need to know what that's about. So you want to be looking at the operating profit. From there, you can add back depreciation on the balance sheet, which you will see charged for the year, and that will effectively give you an EBITDA, earnings before interest, tax, depreciation, and amortization. So once you've got an EBITDA figure, or even just looking at the profit, remember there's different profits. There's gross profit before overheads, operating profit after overheads, profit before tax, which typically will encompass any interest payments or interest receipts, plus, of course, depreciation. And then finally, the tax charge, and finally, profit after tax. Now, Charlie Munger, Warren Buffett, they would always prefer profit after tax, saying that that is the real profit at the end of the day. I would agree with them. However, the whole of the mergers and acquisition market tends to work on EBITDA. But be aware that's not the only method of valuing a business. So we look at that. Work out the EBITDA, let's stick with that. And then you can have a multiple of 2 to 3 to 4 for an SME business, not much more. Occasionally it might go to 5 in software. We tend to work around a multiple of 3, although I fully understand that's a yardstick. It's not something that's always set in concrete. No way. And then we go to the balance sheet. Now, we focus, first of all, on the assets of the balance sheet. We do not come to our clients directly for monies to put into the business. Okay? So we're looking at, and I've been through this many times before, we're looking at the tangible assets, not the intangible. They really don't have a value. The tangible assets, which will be real estate, bricks and mortar, plant and machinery, motor vehicles, trucks and vans and cars. Okay, what is their value on there? Coming down, we have maybe stock. If the stock is in good shape and saleable, that can have a value and could be financed. Not a great deal. It's not a favorite with financiers, but it can be done. And then we come to receivables or the debtors. Money's owing to the company. Now, if they are B2B and not B2C, they can be financed and they're a favorite source of funding. You can set up factoring with them, some form of invoice discounting, confidential or not. It's a pretty easy thing to do. The factoring firm will want to make sure that the debtors, the receivables, are all kosher, that they are not bad debts. They will do credit checks on various of the debtors to make sure that they are, serious companies and will pay well. And then, of course, we come to the cash. And the cash is obviously a tricky area. We work out what the normalized working capital is for the business. We take an estimate of that to start with. We can't get into great depth until we do financial due diligence, but we have a pretty good idea of what the cash requirements are for an ongoing business of a certain size, whether it's 10 million, 5 million, 1 million, whatever. And then if there's a lot more cash in there, then the question is, how is that going to be treated? Is it going to be cash-free, debt-free? Will we have an opportunity to include it and pay the vendor with some of his own cash and take advantage in the United Kingdom of BADR, Business Asset Disposal Relief, currently 18%, I believe. That can be, we're doing that right now with the deal. We've done it before. It seems counterintuitive, but it's the way things work. So basically, we end up with a valuation, we end up with a certain amount that's going to be paid up front, and then, of course, vendor financing comes into it. We always use vendor financing. So these are the ways that we would value a business. And to come back to the original position of what makes a business worth buying, that's one of the key ones. You want profitability, yeah, and you want preferably an asset-rich business on their balance sheet that gives us the opportunity to finance from the target company. So what we're looking at here is a combination of financial DD and commercial DD. You need to use your mouse, read the press, listen to news and whatever. If you find out that, I don't know, car employees somewhere are suddenly going on strike and that's going to affect a certain market, then you need to be aware of what's happening in the sector. So the sector, the current management, of course, what you feel you can do with it. Is there going to be second-tier management who can keep running the business? But remember, you need to impose your stamp on the business and make sure you don't want it just to trundle along as it was before. Well, if it was making lots of money before, yes, you do. Typically, within the year, the existing management, senior management will not be there. So what can you do to improve it? Talking to the vendors, be careful. They will always talk, invariably, they will talk in terms of jam tomorrow. I don't know if you know that phrase, but all the jam is going to come tomorrow. All the good stuff's coming tomorrow. Of course. Well, if that's the case, why didn't you create jam today or last year? So beware of, vendors who are over talking their business. But in general, you want a sector that's booming, hopefully sensible management, but current management that you feel you can probably improve on, more marketing, more sales, and blah, blah, blah. Then has it got assets on the balance sheet? Is it profitable? Are there assets there that can be financed so that you don't have to put your own money in if you have it? And then the financing is so important. And then looking a little bit further, the takeover of the business, who's going to stay, who's going to go away, and so on. So these are some of the facets you want to look at when you're looking at buying a business, because we see hundreds and hundreds of businesses. Most of them are in pretty good shape. Some of them are distressed. Some of them are semi-distressed. And if something's not done fairly quickly, they could go bankrupt. We spot that in an instant. But then often the vendors, not all the time, but the vendors are asking too much. So we need to negotiate a good position. But the key aspects of the business have to be solid, or you're an entrepreneur that's prepared to take on a distressed or semi-distressed business, maybe a business even in administration. And there you would be looking to use your business skills across the board to refinance and restructure that business to make it go further. So I hope some of these hints and tips have been useful for you about what to look for when looking to acquire a business. Okay, many thanks.